in a world where gold ownership, according to Rick Rule, in the United States is less than 0.5% of total assets held, from the Harvard Endowment Fund all the way down to Joe and Jane Sixpack. If people wake up because the banks start to crater, and I think you will see that, more banks are going to fail as rates continue to rise and the economy slows, and the strains and stresses that it's putting on the system. And when there is a bail-in, where anything over the 250,000 FDIC limit is then taken and bailed into the bank, rather than the taxpayers bailing out the bank, as the law, Dodd-Frank law says, and people lose everything, I think it will, like that, people will wake up, because most people don't know what a bail-in or that it even exists.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome to the Money Level Show, where we think, act, and prosper. My name is Daryl Thomas, and here on this channel we focus on changing financial trajectories and building legacies. Today we have the pleasure of interviewing Andy Schectman. Andy Schectman is the CEO of Miles Franklin. Miles Franklin deals in bullion such as silver, gold, platinum, palladium. Andy got started early on, and he specialized in Swiss franc investments. He has been the CEO of Miles Franklin for over 30 years, and he brings a lot of knowledge to the table. In this interview, we focus on the banking system and how people should own wealth outside of the banking system, such as gold and silver. As we've seen earlier this year, banks go bust. So you want to make sure that you're protecting your wealth and your capital, and Andy is here to drive that point home. So please hit the like button and the subscribe, and I'm going to share later on about the New Orleans Investment Conference, and I hope that you consider clicking the link in the description below so that you can attend this conference, which is one of the best investment conferences out there. So without further ado, let's get to the interview. Hey Andy, how's it going?
It's going good, Daryl. Thanks for having me, buddy. Nice to meet you in person at the Rule Symposium a few months ago. Glad we're finally able to connect.
Yeah, you was busy, you know. I saw Andy. I was like, Andy over there on his hustle. He on the grind over there. So, you know, I didn't want to bother you too much.
Not a problem. That's the name of the game. Been doing this for 33 years, and you know, I don't know. You don't have to be the smartest guy in the world if you have good hustle, and you can make relationships, and that's what this business has really, I guess, where I found my success is finding relationships and doing as I say, and you'd be surprised what a little bit of grind can add to that. And here we are 33 years later, and glad to be here with you.
Yeah, it's very important, you know, not just the work ethic, but the reputation that you uphold throughout the years of doing business, because otherwise you won't survive.
Right. Well, and you know, we were both connected by Rick Rule, and you know, this is an example of a relationship and doing things the right way. You know, he is someone who I seeked out over 20 years ago and asked if I could be involved, and made a proposal, of course, in servicing his clients. And even when he was global resource and then the president or CEO of Sprott United States, and you know, he's someone whom I have the most respect for, and he is respected maybe more than anyone in this industry. So it's about relationships. It's about doing as you say. It's about, you know, striving to over deliver. And in 33 years, we've never had a customer complaint. Now, that doesn't mean that in the 9 billion sales that we have transacted, we haven't made mistakes. We have, but we own them and we make them right, and then some. And so, you know, I guess, I know really this isn't where we were going with this discussion, but since we're here, the bottom line is that in business, when you're talking about a commodity like precious metals, you don't buy the commodity, you buy the company, or you buy the person. And I guess you never realize how important a reputation is until there is a problem. So that's one of the things that we hang our hats on, and I'm very appreciative of Rick, my relationship with him, and that he put us in contact. So, you know, the the list of relationships goes on, and that's how it's worked for me for a very long time.
Yeah, and honestly, I would not have a complaint in these high premium environments. I've seen just from watching Liberty and Finance, in their channel with Dunnigan and seeing the pricing that you have for the metals. It's very fair, and it doesn't look like you're trying to get over on people with super high premiums in this current market. And so that's something that I really enjoy about Miles Franklin.
I appreciate that. Yeah, the high premiums, look, so people understand, I guess it's worthy of mentioning that when you have the price of gold that you see quoted, that's the price of raw gold or a bar of gold. That's the spot price. That's not even the bar price. That's just the spot price. It's like a barrel of oil. Well, how much does it cost to refine that oil and turn it into motor oil or into gasoline? And so when you talk about the premium, well, let's talk about the United States Mint as an example. And if you have a blank disc of gold or a blank disc of silver, it's called a planchet. Now, the cost of turning that blank piece of gold, well, first of all, there's a cost in turning it into that blank piece. So you buy it in a 1,000-ounce silver bar or 100-ounce or 400-ounce gold bar, and you melt it down, you turn it into shot, and then you melt that down and turn it into a planchet, a blank disc, and then you stamp it and you put it in tubes and you put it in boxes, and then you send it out, and you have the cost associated with acquisition of the metal, production of it, running the mint, distribution, advertising. All of that stuff is the baseline premium. And then you have the supply and demand premium, which is a greater indication really of where we are in this cycle. And for the past 3 years, premiums have been, as you mentioned, very, very high, higher than I have ever seen in 33 years. Now, they've come back down right now to the lowest I've seen in almost 4 years. And to me, it's counterintuitive. If anything, they should be higher than they've ever been based upon what I see happening in the world. But look, the bottom line is this, is that we're consistent on bid, meaning we're buying from you, or ask when we're selling to you on elevated premiums. If you're paying a high premium on some item to buy it, that's what the market is paying for it at that moment based on supply and demand. Forget about the production costs. That's always what it is. But the demand rooted in supply inefficiencies or greater demand because of what's happening with the banks or with the BRICS or with the economy or with politics, the realization by the mainstream that these things are happening and that there are very few places to hide, I think will only make premiums go exponentially higher as the public wakes up. And maybe it's the fuse being lit is a banking problem where the banks are bailed in instead of bailed out, as the Dodd-Frank law says they're supposed to be. And I think that's coming. But anyways, bottom line with all of this is that whether you're buying or selling, if you're paying an elevated premium to buy it, you're going to get an elevated premium when you sell it back to us. And in a world where gold ownership, according to Rick Rule, in the United States is less than 0.5% of total assets held, from the Harvard Endowment Fund all the way down to Joe and Jane Sixpack. If people wake up because the banks start to crater, and I think you will see that more banks are going to fail as rates continue to rise and the economy slows, and the strains and stresses that it's putting on the system. And when there is a bail-in, where anything over the 250,000 FDIC limit is then taken and bailed into the bank, rather than the taxpayers bailing out the bank, as the law, Dodd-Frank law says, and people lose everything, I think it will, like that, people will wake up, because most people don't know what a bail-in or that it even exists. You see that happen and you'll see premiums go parabolic. And I will tell you that literally since January 2020, these are the lowest premiums across the board, the greatest availability across the board that I've seen literally in almost 3.5, almost going on 4 years. So Yeah, it is a high premium environment, still higher than it ever was prior to 2020, but the best it's been, Daryl, in almost 4 years.
Yeah, that's you mentioned a few good points in there. Well, all of it was good, but there were some points I want to chime in on. So you mentioned in the law, banks can bail in, which means that they keep the depositors' money. Obviously, we have FDIC insurance, but FDIC doesn't even cover a significant amount of the bank's deposits. So, like, if there's like multiple banks, like say 20 banks, I mean, could FDIC even cover that amount of money? Hello, everyone. Sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview.
Well, first of all, FDIC at the beginning of the year had 125 billion or thereabouts in assets, most of it in, I think, U.S. Treasuries short term, funny enough, backing 18 trillion in deposits. So it's like 0.06 or 7. It's nothing. And what's even more humorous to me is that when Silicon Valley Bank failed and Signature Bank failed and they were bailed out, this is why there was such outrage by the senator from Oklahoma. And he was questioning Janet Yellen. You can Google this, it'll pop up on YouTube. And he says, well, Madam Secretary, you just bailed out these two banks. And we were told that that was illegal, that the Dodd-Frank Act said that that isn't going to ever fly again. And she said, well, we determined that the banks were too systemic. And they would have a very, very negative impact on the market and the banks. And so we took the decisive action of bailing them out through FDIC, but the taxpayer won't be on the hook for that. Yeah, right. Yeah, right, Madam Secretary. But then he goes on to say, well, so am I to understand if a bank fails in Oklahoma that my constituents will be made whole? And she says, no. He says, well, what the hell do you mean, in essence? Well, why? How is that possible? Well, she said it would take an uber majority vote from the FOMC, Daryl, which is the Federal Reserve, the FDIC herself, and the president, in order for any regional bank to be bailed out, only if they were too systemic. Now, the funny thing about that bank, by the way, as a side note, when that bank was under inquiry by the House, they asked the head of the bank, let me just get this straight. The senator says to the head of the bank, you had 10 checking accounts over the last 3 years that had a total of $14 billion in them. $14 billion in 10 checking accounts, earning basically zero with no FDIC insurance above 250 for 3 years, instead of having them in treasuries where there's no risk and your only risk is the US government, where you would have made 20 times the return. Where the hell was risk management of the bank? Where the hell was risk management of those corporations, those 10 corporations? And where the hell was the FDIC then? And then they decide to bail them out? It's disgusting. It's pathetic. But yes, bail-ins mean that if the bank fails, anything over the FDIC limit, which is a joke, would be bailed in to make the bank whole. And anything left over gets passed back out to in a pro rata fashion to the depositors, usually in the form of shares of a now bankrupt bank. And you hope a company like JP Morgan gobbles them up and you get new shares. But yeah, it's going to happen. And as rates keep going higher, as people leave and let's back up. I don't know how many people understand why this has happened, but the bottom line is that during the pandemic, the president told the banks that they could relinquish basically all the reserves. Didn't have to have reserve requirements. So when you deposit $500,000 in the bank, that's your asset, it's your money, it's their liability. And by law, they have to offset that liability with an asset. So they would buy treasuries, and they were being incentivized by the Fed to do this. They would buy treasuries, which they figured were safe, and they would buy mortgage-backed securities, where they bundle mortgages into a security, into a fund. The mortgage-backed securities over the last, go back 2 years and back 4 or 5 before that, were 3 and 4%. The treasuries at 0% federal funds rate were between 1 and 2% 10-year. So they're loaded up with treasuries and mortgage-backed securities that are worth roughly 50% of what they were a year ago, as rates have gone higher. And if they're held to maturity, they'll get their money back. But if depositors, remember, they don't have much in the way of deposits. And if depositors say, no, you're in trouble. We see it. Look at the charts. Look at it. Look at Schwab. Look at PNC. Their numbers are ridiculous. They're right wedged in between Silicon and Signature Bank in terms of their problems. And if all of a sudden everyone goes to PNC and says, I want out, I want out, I want out, I want out, they have no choice but to sell those treasuries and those mortgage-backed securities to meet the redemption request because they don't have the money on hand. And in doing that, bang, the whole thing implodes, just like Silicon Valley Bank did in under 36 hours, where the run on deposits made them sell their assets at 50 cents on the dollar, and those unrealized losses became realized, put them out of business. Well, that's going to happen. And as more of these banks are forced to sell those bonds, it only pushes interest rates up higher, which makes the balance sheets of all the other banks worse and worse and worse, and it keeps it a self-fulfilling prophecy, and it collapses. And Janet Yellen is going to bail in these banks. People don't get that. But, it's even worse if you have a business. Let's say you're running, you got a couple of bakeries and you have $3 million in an account that's for operating capital. You got to buy the wheat, you got to pay the trucking company, you got to pay your employees, you got to pay the brick and mortar, you got to pay it all. And that bank goes under. Well, what happens to your business? Sorry, you're screwed. And that's what I see coming. And when that happens, I think you'll see premiums on gold and silver go parabolic, because most people in this country have not a clue that gold and silver are wealth and have been wealth through 2 world wars, German hyperinflation, the Great Depression, every pandemic, and everything the world has ever thrown at it. And at the same time, the most influential, well-funded, and more importantly, well-informed central and commercial banks are buying it at levels no one's ever seen. Over the last 18 months, the central banks bought more gold than any time in history. Why? Oh, by the way, the Bank of International Settlements, which is the central banker's central bank, quietly in April of 2019 in the Basel III rules classified gold, reclassified it as the world's only other tier 1 reserve asset. The only other one next to US dollars. So do you think there's any reason why the central banks are massively accumulating it? Do you think there's any reason why the Chinese and the Russians are not screaming that we've suppressed the paper price on COMEX because they're the ones accumulating it all? Until they've got more than people are willing, until the price is stupid enough and the demand is high enough that the suppression on COMEX at 35 times leverage, roughly, futures contracts that can control the price, making the dollar and the bond market seem stable rather than gold going to the moon and signaling, well, all is not well behind the curtain. They're not complaining because they're accumulating until no one wants to sell at those prices anymore. And then watch what happens when you see the price mechanism of the West, that being the COMEX and the LBMA, rendered obsolete. And we see a more proactive price setting mechanism arise from maybe the Shanghai Metals Exchange or the new Moscow Metals Exchange or the Dubai Metals Exchange, wherever it is. These are the countries accumulating and producing it all while we, in our infinite wisdom, suppress it and sell it. And there's an old saying, Daryl, that he who has the gold makes the rules. So keep an eye on that one.